going to be a basic introduction of market structure. Again, uptrend. So what is an uptrend? This is defined as market structure that is breaking the highs and maintaining the lows. In simple terms, a market that is making higher highs and higher lows. The previous or last high, which is the higher high, should always break, while the previous low, which is the higher low, should not be broken. And if I put an example right there, right, we start with a low, we make a high. This low should not break in order to maintain the uptrend, right? But this high should always break in order to maintain the uptrend, right? So again, the last higher high should always break. The previous higher low should not be broken, okay? And again, we have a high. This is the new higher low. It should not break. There is the new one. What it should do, it should go and take out the high. So very simple, and I'm sure you know this. Again, this is not, this is more like a textbook, but what you're usually gonna have in the live market is something like that. Right? It's not clear. You have a push, the market then starts to chop around. It gives you like internal structure. But what is really important is that you always track the market down to spot like what is my major low, what is my major high. As the market pushes and breaks structure, you track it down. This is my major high or low, and it does not happen. It does not matter what happens within right there. As long as the market stays below this low, right, we are still targeting the high. And I'm going to show you why this makes sense a little bit later. So there is again, a price action chart. So we don't have anything right there. And what you can do is you can start drawing support and resistance. You can start drawing trend lines. You can start drawing, I don't know, you can put some indicators right there. But again, how I believe the market structure is drawn, or how I believe the market should be traded, is like this. Okay. Always mark your major structure for now with a thin line, like with the bold line. Like this, right? So make it bold, not very thin, okay? Lower lows and lower highs when the market is bearish, mark them with a little bit of a red highlighter. When the market is bullish, with blue, okay? So there is the break of structure right there. What caused the break? We track the market back. It's this guy. We put a red highlighter right there, and then we put a line. Here the market broke. So again, just before I continue, I take wicks as breaks, and I'm gonna explain why a little bit later. Here we break up, right? We break down actually. So here you could have said that this right there was a liquidity grab, because then the market just wicked it up and then continued to break down. Okay, so we have a new structure break right there. What caused the break? We track it back. It's this guy. We put this. So this is our strong high, as I'm going to teach you later. The market pulls back, break structure down. Cool. What caused the break of structure? Track it back is this guy. This guy comes in and breaks. So what do we have right now is a trend change. And then the market shifts uptrend. Okay. And always see how those higher lows are maintaining. Like sometimes it can wick by a little bit or maybe form equals. That's fine. It usually keeps going on until it shifts. And as it shifts, we start making, so this is our strong high right now. Push, pull back, lower high, push, pull back. This is the last lower high. So we should not break above this one, but we should break the low, push, pull back. This is the high that shouldn't break, and have a look how perfect it is. It's not supposed to break. And this is why I take wicks as breaks, because if this level is strong right there, if this level is so strong, I don't want to see it get broken by a wick. Because even if it gets taken by a wick, then this to me means that, okay, there are buyers entering the market. They took out this level, so we can eventually start shifting up. And again, don't get me wrong. Sometimes it happens. Like here it happened. We wicked up, but then we still went down. Here it also happened. We just wicked down for a little bit, but then the next candle immediately continues to go up. So you're like, okay, well, this was just a little bit of a liquidity grab right there. So this is an example of an uptrend, okay? Downtrend, market structure that is breaking the lows and maintaining the highs. So exactly the opposite. In simple terms, a market that is making lower lows and lower highs. So again, here, the previous and the last lower low should always break, while the previous high, which is the lower high, should not be broken. And again, to illustrate it, there it is, right? We have a high, we have a low. This low should always break, this high should maintain. We have a low, we track it back, this is the lower high, this one should hold, this one should break, okay? And we keep going on like this until, of course, we have a trend change and the market reverses. Once again, don't get married to these textbook scenarios right there. The market is usually going to be much more complex when you put candles on the line, right? So it's usually going to look like this. But as I keep saying, it's always important to track back the major lower high. So let's have a look at an example. There is a pretty big one, right? So you can actually pause the video right now, pause the video and try to mark it up, right? Just take a screenshot, go mark it up, and let's compare later. So here's my markup, right? So what I just simply do again is I just follow structure, okay? So this is where we broke. We made a new lower low. What caused the break? I track it down. This is right there. We have a pullback. In my private program, we have very specific rules. Did this, then came in, respected this, right? Then it broke down. In this case, we have to track it back. What caused this break right there? According to me, it's this one. You might say it's this one. Some of you might say it's this one, right? So again, you need rules. What is your lower high? According to me, it's this guy. We pull back, lower high, lower low. There is the lower low, right? So we know when the lower low has formed, when you have like at least 2 candles in the opposite direction, okay? And then we track it back. There is the major lower high. So this one should not break. The market pulls back, makes another break of structure right there. We track it back. The most important question is, what caused the break of structure? You track it back. There it is. The market pulls back, holds below it, continues to break on. Here, there is a break of structure. It occurred exactly right there. You ask the question, what caused the break? Okay. You can say, according to me, it's this one, but you can say it's this one. You can say it's also this one. Okay. This is why, again, you need clear rules. This one, as you can see, got respected. The market gave us a pullback, massively dropped, another pullback, massively dropped. Here you can see the level was invalidated by a very little wick. So again, according to me, this is a reversal. And then this to me turns into the major low, which is a higher low. So we have a push, pullback, push, pullback. The market tried to hold, and what it did is again aligned bearish on the forward. So we had this little short-term pullback. Break below again. What caused the break? It's this. We track it back. The market consolidated, took out the low. Good. What caused this low to be taken? Tracking it back, it's this. The market came in, reacted, and reversed, right? So then what caused the reversal? What caused this break? It's this low. It's not this. It's not a valid range. It's this, right? Push, and then we just keep going, okay? And then you're going to have, of course, you can see the market is not perfect. You have like ranges right there. You have ranges right there. You're going to have a bullish market overall here, but you have 2 very big ranges. But still, what is really important is that you always, if you have this break of structure right there and makes a new higher high, what is the higher low that caused the higher high? What caused the break of structure? You track it back. It's this guy. You draw your line and you can see perfectly, doesn't matter what we do. If we are above this guy, we expect the high to go, and I'm going to tell you why we do that later. Got taken and then we reversed. Okay, so very nice example. This is downtrend. And another example for you. So again, pause the video and mark market structure right there. Right, so again, here, there is your structure. So I just went on and this is on the Dow Jones. So this is US 30. I just went on and marked structure. And you can see this one does not look perfect. Okay. We have a downtrend. We always track what are the major lower highs. Here we had a very little alignment, right? But you can see the market made push, pullback, push, pullback, push, pullback, right? So if you are looking at the market from a macro perspective as well, right? You can say, this is my lower high. This is my lower low, right? And then this is my lower high. Well, usually this is a little bit wrong. It's not wrong, right? But then you're missing out on all of these setups, right? They're all of these setups. Then you're missing out on this short-term uptrend, right? And again, what a lot of people tend to do is, of course, draw like very big macro structure, like something like this, okay? Which is, again, not wrong, because pretty much this is a quality time frame, but on the daily, this is going to be a push, this is going to be a pullback, then this is going to be a daily push, and this is going to be a daily pullback. And as you can see here, the 4-hourly time frame starts to range, which means that potentially like it's accumulating for another move. Okay, so make sure to practice this. The final market is a consolidating market, which is very tricky, and it's defined as market structure that is failing to break both the highs and the lows, or is just throwing wicks above or below, right? Ranges, by the way, are very important because this is where the BFIs are cooking. This is where they're exchanging their orders and agreeing to potentially move the market, right? So this is where they decide where they want to go next, all right? So I want you to go on your charts right now and go and spot like a very big move somewhere. And I promise you, before this big move, there is going to be like a period of a consolidation, right? And there is going to be usually a liquidity grab. So usually what happens is the market goes from a downtrend and then starts to range a little bit. It ranges, like starts getting a little bit sloppy. And then you have this. Okay, so what happens right there is the market is accumulating orders, is building up orders. Then there is usually going to be a liquidity grab. which I'm going to teach you in the supply and demand video coming up next, and then the market just massively expands.